Hey everyone, happy Thursday, April 6th. It's about 11:45 on the West Coast, and it's time for another market update. And happy Easter and happy Masters Week for those who celebrate. Besides being Easter week and being Masters Week, it's also a lot of inflation news and it was jobs week for market news. So a lot of stuff to cover, so I'll get right into it. Going back to last Friday, we got February's PCE inflation numbers, which is the Fed's favorite form of inflation readings to look at. I was worried about this. It was supposed to come down. I didn't think it would come down as much as expected. It actually came down more than expected. So awesome news. Year over year dropped from 5.3 to 5%. Core dropped from 4.7 to 4.6. But in these numbers, shelter housing is still going up, 0.7% month over month and 8.2% year over year. As we've taken a look at, that doesn't jive with what all the other metrics show as far as rent inflation across the country. So looking at this graph, we can see basically rent inflation peaked in November of 2021. So like 15, 16 months ago, whereas PCE is still showing it going up, at this point, here we're in March of 2023. April 2023. These are March or February's numbers. So we know on the horizon we have that working for us. Personal income went up, but not as much as expected. Personal spending wasn't as much expected. That's all disinflationary. That's all good for us. The next thing on the inflation news we got was OPEC. OPEC decided to cut production by 1.6 million barrels per day. This is something we got to keep an eye on. This is not good for inflation. This is, if they don't have as much oil, then gas prices could go up. That could translate to higher prices and inflation. So we definitely want to keep an eye on that. And then starting jobs week was on Tuesday. So the first one we got was JOLT's job openings report. That was expected to come at 10.4 million job openings. It was only at 9.9 million in February. Leisure, there was 87,000 job openings lost. That's important. We know that leisure has been kind of leading the way on all these job things as they refilled their jobs that were lost over the pandemic. So this is another sign that gain that they've been propping up these reports is kind of slowing down / going away. So not as many job openings. That's good for us, not maybe good for the economy. ADP, which is private payrolls, that was supposed to have 210,000 new jobs created. It was only 142,000 jobs in March. And so that, again, is they missed the number. Again, not necessarily good for the economy, but good for inflation, some of the worries we have on the job front as far as the job market being too hot. Leisure actually gained in that one. So going back to the last point, leisure, it might have been worse if leisure still wasn't showing a lot of gains for ADP. And as we said, we expect those to start leveling off and going away because they've basically caught up to where they were pre-pandemic. Today, we got initial job claims. This is an important one every week, actually. But today they made a big change. In the number like we've talked about before. These are all seasonal adjustments. It's not like they just count all this. They're doing a bunch of math gymnastics based on seasonal adjustments and things like that. They made changes to the seasonal adjustments and the math for the last 5 years and went back and revised things. So it shows we dropped, from 246 last week to 228. But last week, originally, I think we only thought it was like 204,000. So, the 4-week average was below 200,000. Now it's at 238. Continuing claims keep going up. So that means people are having a hard time getting jobs once they are laid off. So this is all, again, we have to keep an eye on it and be concerned about it as a country, but this is all kind of working in our favor, what we want the reports to show the Fed, to be like, hey, the job market's slowing down and inflation's slowing down, cut it with the rate hikes. So the next one, purchase apps. Purchase apps were actually down last week, 3.5%, year over year down 35%. Rates were down, but purchase apps are down mainly because there's no inventory. We'll get into this in a second, but there's nothing for people to buy, so people aren't applying for things with me and other loan officers. Generally people see things on like, oh, I want to buy that house, and they find a mortgage lender and apply for a loan. But right now there's just no inventory out there, so that's definitely hurting purchase apps. More inventory, rates come down, maybe more sellers get on it and list their homes, then we'll see those apps go up. So where does that leave us? The average 30-year conventional last week was at 6.59%, according to this letter survey, which again is, people on the higher end of this. Most people are going to be, higher on the rate level. It was all the way down to 6.18% today. So over 0.40 drop, a big drop, nice to see. But we want to be careful and make sure it's not for all the bad reasons. We want inflation to come down, but we don't necessarily want everybody to lose their jobs. We want that pressure to come down. We want the Fed to see that they should stop, but we need to keep an eye on employment. We don't want rates to be low and no one be able to afford the house anyways because they don't have jobs anymore. Important dates coming up. We got the BLS jobs report tomorrow. That's a very important one. I'm cautiously optimistic on that one because they use a sample week, and the sample week they're using is 2 weeks ago, where it had a big jump to 246, where they did that revision. So that's going to get mixed into their math gymnastics, and hopefully that comes in our favor and shows the job market not as strong as it was, and that tells the Fed to back off on their rate hikes. And then after that, for April 12th and April 28th, we got the two next inflation, the CPI and the PCA reports. Then I believe May 3rd is when we're going to have that next Fed rate hike announcement. Right now, the markets have it at about a coin flip, 50-50 either way, no hike or 25 or a quarter of a point hike. So we want no hike. We want that, or even a cut would be awesome, but we're probably not going to see that. They should, but they won't do that. So what I want to talk about, finish this with is what would happen if rates do come down a bunch? And I'm not sure if the markets can handle it. Right now, there's not a lot of existing inventory out there. We'll look at that in a second. But, home prices, have been coming down, and it looks like we might maybe have hit that bottom. According to, CoreLogic, we're up 0.8% in February. Zillow just came out with their February numbers. I believe they were up as well. FHFA was up in January. Black Knight was up in February. And then since the peak, really, the highest number on here, we're down since the peak in June of 2022, but the highest number is down 2.9% nationally. Again, that's going to be higher in Central Oregon, maybe a little bit, higher in the Bay Area, Los Angeles areas, but still a far cry from a crash. And then the national news media is housing news media is a little, irresponsible, using that crash term over and over again. And it scares people away. It makes people not as willing to list their home, buy a home, and all that. And it's definitely put a hurt on the industry. And then, keep in mind something to tell your buyers. In the 10 years prior to the peak, housing was up 116%. In the 2 years prior to the peak in June 2022, it was up 40%. So buying a home was a really good deal, and losing 3% of that 40% is not a huge deal. So it still was a great deal for those people to begin with. And then right now in the United States, we're at 563 active existing home listings in the U.S. Not a lot of inventory out there. Better than last year, better than the all-time lows. But if you go pre-pandemic, we're about half that. You can see where the normal housing existing homes were at, and we're nowhere near that. So as I said, if rates come down a bunch, and all of a sudden you got a bunch of people that are on the sidelines saying, I don't want to buy a home right now, rates are too high. If all of a sudden they jump into the market when there's not a lot of inventory, you get multiple offers, you get bidding wars, you get things like that, and home prices going up even more. So if you have buyers, if you're a buyer or buyers that are thinking, hey, I'm going to wait till rates come down to buy, it might be a wash. Everybody else is thinking that. So all of a sudden you're going to have 15 offers on a house. So instead of maybe you get it for a higher rate for $50,000 lower, or you get it for a lower rate for $50,000 higher, and it's the same payment. So, that's something everybody needs to keep in mind, is that we all want rates to come down, but could our housing market even handle it right now with as little listings as we have? We really need more inventory to handle the amount of buyers that would jump in the market at that point. So that's all I got for you guys today. Good week overall, inflation down, jobs hurting. We'll got a close eye on that jobs report tomorrow. I'll update you guys on that next week. I hope everybody has a great Easter weekend. And if anybody needs anything at all, please do not hesitate to reach out. Have a great day, everybody.